Real estate income from an asset.
Yes.
You know, yeah, if you have a rental property and it's generating rental income, that's called passive income.
Okay.
That actually gets taxed at a high rate in the corporation.
Welcome back, everybody. This is episode number 5 of the Secret Ingredients to Real Estate, and we've got some amazing guests here today. But I want to first introduce our chef, our Michelin star chef, Dimitri Ramirez, and then we have Darren over here from Murphy and Chung, and we have Samantha Brown from Murphy and Chung as well. Yeah. Awesome. And today, what you're going to expect from us is we're going to talk about the underhousing something tax that Darren's going to talk about, and we're going to talk about corporations and how to set up corporations to buy real estate, and in general what's happening with, you know, taxes and real estate. So let's get started with what are we cooking today.
Well, first of all, I would like to welcome Darren and Sam, right? I know you.
Yes.
Yeah. You're normal, maybe normal.
Yes.
You're regular, okay? Today we're cooking, we're going to have French lamb chops, right, on the barbecue.
Nice.
It's springtime, so what better way to celebrate with spring lamb, right? We have a Greek salad. We're gonna have wedged potatoes in the oven and a little bit of tzatziki so we can all spice things up, right? It's healthy, it's easy, and it's crowd pleasing. Maybe, I don't know.
Yeah, perfect for your Easter meal, right?
Yes, absolutely.
Yeah, you had me at easy, so.
Okay, all right. So without further ado, let's start, okay?
Let's get
I
going.
think you're the chosen person to do the chopping today,
not my choice, but yes, I'm doing the chopping.
Okay,
Awesome.
all right.
I'm also a novice chopper, so why don't you show me what we're
Okay, I will definitely chop you. Show you.
I'm gonna keep my fingers back here.
Yes, please, okay. We'll start with the lettuce. We're gonna use lettuce today. Traditionally in Greek salads, they have the choriatiki and the regular Greek salad. We're gonna do the regular Greek salad with some really good, you know, ingredients. So usually I will go, you know, like about ½ an inch chop the lettuce hearts, right down to the, and then we're just gonna go take that. Yeah, put that away. So now you can do the next one. Just chop this and throw it away.
Watch your fingers.
And do exactly, yes, please, watch your fingers.
That is really sharp. So Darren, while you're cutting up stuff there, why don't we talk about the UHT, right? Underhousing tax?
Underused housing tax.
Underused housing tax. Yeah,
Yep.
Explain to us what's happening there.
Sure. I mean, it's something that's new this year. It was really brought out to increase the supply of housing by eliminating or taxing houses that are not being used.
Right.
So the intention was that, you know, the feeling was that there's a lot of non-residents that were owning homes. They were being underused. We're looking to increase the supply of housing. So they said, okay, let's tax non-residents that have vacant homes.
Okay.
The problem with how they rolled it out is that they've actually captured a lot of people that probably weren't intended to be captured by this. So
this is all on a federal level, because I know in Toronto they brought out
they have the vacant home tax. That's just a Toronto thing. This is a federal thing.
Oh, wow.
So, you know, basically any non-resident that owns residential property in Canada has to file this return.
Okay.
And there's a bunch of exemptions. I mean, as long as it's being utilized, there's certain exemptions if it's being renovated or if it's under construction, that you're not, you know, you're exempt from the tax. But if you have a property that's sitting vacant for most of the year, you're going to pay tax on that. The tax is 1% of the value of the home per year.
Wow. 1% of the value of the home.
Yeah, which can be expensive, but the bigger impact is the penalties for not filing. So the penalties for not filing, it's $5,000
okay.
For an individual. Plus, if you were entitled to an exemption, if you late file, you're not entitled to that exemption anymore. So you're subject to the tax plus the penalties. So that was the intention. Yeah, that was the intention of the rules is to target non-residents that own you know, residential housing that was being underutilized.
So,
but the way that they rolled it out, sorry to interrupt you, the way that they rolled it out is they've actually captured any corporations that are not public that own residential property have to file. As long as you're a specified Canadian corporation, meaning you have less than 10% foreign ownership, you're exempt from the tax, but you still have to file. So for a lot of people that have investment properties in corporations, they're not exempt individuals, so they actually have to file a return. Same with trusts.
It's a 9-pager.
It's a 9-page return. It's a real pain in the you-know-what. Most of them, like I said, most of them, they're exempt from the tax. You don't have to pay the tax, but if you forget to file the return or just unaware of it and don't file the return, penalties for a corporation is $10,000 per year, plus the same thing, you lose the exemption of the tax, which if you have $1 million property, that's another $10,000 plus penalties plus interest, so you're $20,000 per year per property for not filing this thing. Even if you're not really, even if you're a resident of Canada.
Due on March 31st.
Due on April 30th.
Oh, okay.
Yeah, so you still have time. Yeah, you still have time. Reach out to your local accountant, get some help, get some advice.
Or reach out to Murphy and Chung. I hear Sam, you do great with the paperwork. She's on point.
Yeah, Sam is our non-resident specialist. She's also our office manager. She's also in charge of keeping me out of trouble and making sure I don't do anything stupid. So she wears a lot of hats, and she's busy, mostly with keeping me out of trouble. That's probably a full-time job in itself.
That's awesome.
Yeah, no, definitely non-resident housing tax, something that's new this year. Not a lot of people know about it. So any residential properties held by a corporation, held by a trust, held in trust for somebody else, which we do a lot as well too.
Okay.
A structure that we use a lot in avoiding probate is you'd have a property, say mom and dad own a property, they would bring a son or a daughter on title in as legal title only, not beneficial ownership. So that's what's called a trust agreement. So by creating this trust agreement, now you have created a trust that now has to file a return for this underused housing tax.
Okay, so let's talk about the trust for a second, because man, you just raised up like a lot of stuff over here. So I had like a list of questions, and now it's okay. Let me start with the trust part.
Okay.
So there's some people that buy properties in trust, but it's not like it's owned by, let's say Sam, you buy the property, you own it, but your mom holds it in trust, and it's just a piece of paper that's here. So how does that person file that tax?
Well, so they have to, so the trustee, whoever is the trustee. So there's two terms that I guess we should define first in terms of ownership, and they're independent. So there's legal ownership, that's who's on the legal title.
Right.
And then there's beneficial ownership, who is the beneficial, like who beneficially owns the property. So all of the tax treatment, income tax treatment follows beneficial ownership. So legal title doesn't mean anything.
Okay.
And a lot of times where this also comes up in a lot of cases is, if, son and daughter, they're just getting started, they can't get a mortgage on their own, so mom and dad are asked to co-sign for the mortgage. A lot of times the bank will ask them to go on title for the property too. So they go on title for the property, they go on title for the mortgage. They have now, maybe inadvertently, created a trust agreement.
How's the salad, by the way?
I hear it's coming along great. Haven't touched it. Yeah,
the chef ran away. She said.
She's taking care of everything. I've been kind of watching out of the corner of my eye. It definitely looks like a salad, but that's all I can vouch for at this point. Awesome. So in that scenario, you've created a trust agreement by putting mom and dad on title because they're on title for the property, even though it's beneficially owned by the child.
Okay.
So you now have this trust agreement where, again, so the parent is on legal title, but they're holding legal title in trust for the child. That's a trust agreement. Trust agreements are captured under this UHT because now they are an affected user, but they're exempt from the tax because they're Canadian residents, but they still have to file their return.
Interesting.
So is it residents or just citizens? Because I thought it was citizens and PRs.
Citizens, sorry. Okay. Yeah, you're right.
Okay. So because it's confusing when you say non-resident, and we have non-resident Canadians as well. Yes. So we have to redefine that because it gets really confusing. And I know, like, for most of the viewers who are watching this, they're mostly residents, but then they're learning about these different terms, and I don't want to overcomplicate this because this is like episode 6, 7, and 8.
It is. We could do a whole series on this. I don't want to overcomplicate this. Yeah. Citizenship is simple. You're either a Canadian citizen or you're not a Canadian citizen. Residency status has nothing to do with citizenship. It has to do with two things. So you could be a factual resident, which is you have a spouse, principal residence, and dependents. If you have 2 or 3 of those things in Canada, you're a factual resident.
So
if you're not a factual resident, but you spend more than 183 days a year in Canada, you could be a deemed resident for that year. So either deemed resident or factual resident, both of those are residents for tax purposes, independent of citizenship.
Interesting.
Dimitra, how's it going out there?
Oh my God, this is gonna be amazing. Look at this rack of lamb, right? It's been marinating since last night in olive oil, salt, pepper, oregano, and some rosemary. It's il gusto perfetto.
Is there anything that you want them to do while they're in here?
While they're discussing all these tax things, which goes over my head majority of the time, the Greek salad is already ready. Someone needs to open that jar of olives because,
Okay.
Okay?
All right.
Thank you.
Is Sherif going to do the honors?
You want to do the honors? You want to be on
Cam? No? Okay, awesome.
You want to do the honors?
No,
I'm
so-
going to be very embarrassed if I can't open this.
It's okay. We've got
Okay.
rubber gloves, my friend. Don't worry, it's all good.
Ah, we made it.
Yes,
we made
we
it.
got the olives open.
That would have looked bad on camera.
Did you bring these all the way from Greece? Dimitra? No? Okay, awesome. All right, so Darren, tell us a little bit more about how you got into accounting. Let's like a little bit more about you, because
Do you want to take the long road there? Because it's a bit of a journey.
Okay, sure.
So-
Cold notes are good too.
I'll give you the abbreviated version.
Okay.
So I actually started my career as an engineer. So I graduated from structural engineering, U of T.
Oh wow.
From there, I came out with the dreams that I was going to, design buildings
Yeah.
and bridges. Everything was going to be great.
Yeah.
I came out in the real world. I was designing parking garages and retaining walls.
Oh wow.
Wasn't really what I expected it to be.
Okay.
Went back from there, did grad school, so I did my master's in business after that.
Okay.
Got my chartered accounting license after that. At the same time, kind of.
So you're like the perfect son.
Yeah, a perfect son, as in I spent all of my parents' money on tuition. Yeah. But still probably, that's why they're not retired. They're still probably paying for my tuition.
Wow.
So I spent a lot of time in school.
Okay.
Got a few letters after my name to show for it. So got my chartered accounting license after that.
Wow.
Started at PricewaterhouseCoopers.
Okay.
Bounced around a little bit, did some advisory work, did some international tax,
Yeah.
did some assurance.
Okay.
Really saw kind of a need in the industry for, big firms, they do a lot of things good, but
Yeah.
they don't do customer service.
Yes,
good. So
yes.
they're great at providing advice, they're great at having the knowledge.
Right.
They just didn't do customer service.
Yeah, I think their marketing is actually bigger than their advice. So
It's exactly
yeah.
right.
So a lot of our viewers are investors, right? They're also home buyers, but for example, when I was 22, 25, I wanted to get into real estate, and my dream was to buy one property. And then along the way, I got into real estate, and then it's like, okay, I want to buy more, I want to buy more, I want to buy more. But I was advised, don't set up a corporation yet. Don't set up a holding company. When you get there, we'll sort it out. So we got there, and property values went like this. And then we were trying to save on accounting fees and all this stuff. Now here we are, owning a few properties in our personal names, and now we want to go into a corporation, and then we can get complicated and talk about going into a trust. So how do you tell somebody in their 20s, and then also fast forward, how do you set that up so that it makes sense?
Yeah, so I mean, the complication with doing it after the fact is
Yeah.
now you have to transfer properties. Again, you're transferring title, you're gonna have land transfer tax.
Okay.
You could potentially have capital gains. Now there's rollovers to avoid that, but the
So you
land
buy-
transfer tax
yeah.
is a problem. So we generally don't transfer a lot of properties around because you're gonna pay land transfer tax and you don't really get that back. So
Okay.
it's just an added cost.
So Sam just bought a property, and
Tell me more.
tell you more. So you bought a $400,000 property. It's now worth $600,000.
Cool.
And you decide to refinance it and buy your second property. And so you're gonna buy, this is your second investment property. So should she now set up a holding company or corporation? But we don't know, maybe Sam's gonna be tapped out of 2 properties, right? It's in the last 10 years when property prices have gone up so high that people are able to buy 2, 3, 4, and then they're stuck, everything is in Sam's name.
Right.
What happens? We just
Yeah.
leave it in Sam's name?
At that point, you probably leave it in Sam's name.
Okay.
And I'm gonna sort of clarify, I guess, one of the misconceptions about.
Sam, we're making you richer.
Yes. She's already a real estate tycoon over here, owning all these properties.
Have you met Dimitra? She's on the grill. She's really good at selling property and missing out on all the fun conversation.
Sorry, so I got to clarify a common misconception about
Okay.
owning property in
Okay.
a corporation. People think that corporations have lower tax rates, which they do,
Okay.
on active business income only. So real
Okay.
estate income from an asset,
Yes.
if you have a rental property and it's generating rental income,
Okay.
that's called passive income.
Okay.
That actually gets taxed at a high rate in the corporation. So you don't actually benefit from paying lower taxes in a corporation for passive income. So that's a big misconception. People always think, okay,
So
you
what's the
gotta
tax rate on passive income?
50.17%.
So that even means second mortgages.
Correct.
So how do you save money?
That's on the rental income, but I mean, generally you
Okay.
don't, generally a lot of investment properties, they break even, so you're not paying a lot of tax
Right.
because it's just,
But it's still 50% on the net.
50%. So you're not actually gaining anything.
Okay.
By incorporating. And same thing when you eventually end up selling the property, you can have a capital gain. There's going to be tax on that. Let's keep that nice here. I get very live
Are
talker.
you Italian?
I'm not Italian, no, but I talk like I am.
Yes, awesome.
I move my hands like I am. So anyway, capital gain, same thing. You don't end up saving any tax. So really, I mean, a lot of the advice that people get to throw these investments in a corporation is not always valid, because they do it because they think they're going to be saving taxes.
Is that the same thing as holdco?
That's exactly the same thing as holdco.
Okay, so hang on a second. Let's pause for a second. Sure. So the misconception is buy a property in a corporation to save on taxes, but because it's passive income, you're not actually saving. You're paying 50.
You're getting passive income on the rental income. You have a capital gain on the eventual sale. Both of those are taxed at a high rate in the corporation.
That is news.
Yeah, so you're not actually saving any tax. Now, there are a lot of cases where corporations are good. One of them is limited liability. So if you have a tenant that sues you, they're suing the owner of the property.
But you have insurance for that.
You have insurance for that.
Okay.
So that's not usually a reason to do it.
Okay.
The other is ease of transfer of ownership. So like, you know, if you wanted to sell your shares, or you wanted to transfer it to a son or daughter, do an estate free, something like that, you can do that with a corporation, because you just would exchange your shares, or you would sell the shares, you would transfer the shares of the corporation that owns the real estate. And then also, if something happens to you, you don't have to go through the whole estate. The real estate doesn't have to go through the estate, necessarily probate if it's set up properly. So you can, the transfer of ownership is easier because a corporation never dies, right? Individuals die, they pass away, they have to transfer properties. That creates taxes and problems, whereas in a corporation you can avoid that. So that's one of the reasons why we use corporations.
Okay.
The other, which is probably the main reason, is like for people like yourself that actually that have a business, like have an active business where they're generating income through services, sale of goods, something like that. Those tax rates are very low.
So this is okay. So hold on.
Sure.
You're gonna go back 2 seconds.
Okay.
We're taxed 50%, 50.75% as a corporate on passive income.
Passive.
Now, if you own it personally, is it taxed at 50.75 as well?
It's taxed at whatever your marginal rate is, which if that's the top rate in Ontario, that's 53.6%.
Okay.
Right?
But then
so still a high rate.
But there's write-offs and all that kind of stuff.
There's write-offs, the same write-offs for a corporation as there are for an individual. So again, no advantage there from incorporating.
So what income level are you at 50.3 for 53%?
220.
220.
Yep.
Okay, so it's always better. So it doesn't matter to own a property in corporation,
doesn't matter.
except for like transfer of ownership.
So the other example where we would use corporations to own real estate is, say someone has an active business like you, right? You have an incorporated business.
Like a
PREC. It could be any business. A PREC, an accounting firm.
So PREC is a personal real estate corporation.
It could be a promotional company, whatever it is. Any business that's active, that's not earning income from an asset, but earning income from services or sale of goods.
Okay.
That's active income. So that active income, you only pay tax at 12.2% on the first 500,000, 26.5% after that.
Yeah.
So obviously that's a very low tax rate. That's much less than 53.6%, right? So that 40% tax savings there, you leave that money in the corporation, right? You've saved 40% tax. So in theory, you've got 40% more money. Now you transfer that to a holdco and you use that money to buy investment properties because you've saved 40% in tax, right? So, you know, on $100,000, you know, instead of
so hold on, you use your active income in the corporation with your real estate income, and you can save that?
Well, you use your active income, which becomes retained earnings of the company.
Okay.
You use that to purchase your investment properties, right? Because you're paying way less tax. So, you know, if you're paying 12% tax, you've got 88 cents on the dollar to invest in a property as opposed to 47.
I love this guy.
Yeah, he's
this
great.
just made me $1 gazillion.
I just made him wealthy.
Yeah. Okay, we got to talk more. So we're gonna take a break.
Okay.
We're gonna check on Dimitra because she disappeared.
Maybe we should cook some food because that's kind of the point of it.
But your salad looks beautiful.
Yeah, and
I don't know if I could call it my salad, but it does look beautiful. I did chop the lettuce.
We'll be right back.
Great.